Welcome to MuniLand. This week we're joined by Sean O'Leary, Senior Muni Bond Research Analyst at MuniLand Asset Management. Sean, welcome. Good to see you.
Thank you. Good to see you.
It was just a few days ago that President Obama talked about avoiding sequestration in his State of the Union address. You have some new research that you've put together on how sequestration could potentially impact the biggest cities in the U.S. Tell us a little bit about your findings.
Sure. Well, what we wanted to do is, for the benefit of our clients, to assess what the impact could be from sequestration. And one of the first things you notice when you look through the 20 largest cities in the country is that federal revenues tends to be such a small piece of their overall revenue pie that it's folded into a more broad category like intergovernmental revenue or subsidies and grants, things that also include state dollars and dollars from other local governments. But even if you treat that entirely as federal dollars and you assume an up to 10% cut as a result of sequestration, against total revenues that amounts to no more than 4% for the highest city and as little as 0.4% for the smallest city. Given the resiliency of munis and their ability to adjust their budgets and the levers they have to pull on the revenue side, we fully expect they'll be able to manage a cut like that, really without showing much strain at all.
Which cities stood out to you either way?
Well, you know, they all tended to look pretty similar. Some, again, because of the mix of state revenues and local revenues in with federal revenues, trended a little higher, like New York City, Philadelphia. But in many cases, they look very similar, which gives me some comfort that this story is generalizable across the entire muni sector.
What are the implications for muni bond investors? What should their takeaway be when they see these numbers?
Well, I think they should know that generally federal revenues are not a big part of your typical local government's revenue mix, but where there could be disproportionate impacts would be in communities where there's a heavy federal presence. So maybe it doesn't hit their revenue mix right away, but if sequestration were to take effect and stay in effect a long time, you may see a situation in, let's say, a big military community or a community where there's a high proportion of federal workers. Things like income tax slumping, sales tax slumping, but those would be very specific cases. And as we always say when it comes to muni credit, you want to understand the credit from a bottom-up perspective and look at it that way, case by case. So generally, it shouldn't be a major impact, but you do want to do your legwork on each individual credit.
Would there be any impact on issuance potentially? Fewer federal dollars, the need to raise more money?
There are some bonds in the muni market that have federal backing that could chill those potentially, depending on investor sentiment. Things like highway bonds that may have federal dollars or some types of airport bonds. But we largely expect that won't have a major impact on issuance this year. Issuance will probably be more dictated by how their local budgets are responding, are they recovering or not, what their capital needs are, and their long-term capital plans.
I want to get your reaction as well to what the president said about infrastructure, the need to rebuild. What does that mean for the muni market? I mean, will we see new issuance on the infrastructure front, and could Build America bonds ever come back?
Well, on the infrastructure side, the muni market has been a little bit subdued the last few years as issuance levels have fallen off, largely as issuers work to restructure their budgets and get their budgets back into balance coming out of the recession. We think there's some pent-up demand there that could support growth in issuance over time. The president's call for the Fix It Now program amounted to $50 billion. And when you look at the muni market in any given week, they're clearing $6 to $8 billion worth of deals. So the program that was proposed is the equivalent of about 1.5 to 2 months worth of muni market issuance. So I don't think it would have a significant impact. Also, it involves trying to link private sector parties with municipal entities, and that can be a long and cumbersome process. So the impact, I think, would be quite muted overall. On the BAB side, what we believe that even just the discussion of the sequester and its potential to impact the BAB subsidy has really chilled the possibility of a return of BABs in the future. We think that's a very low probability outcome.
Sean O'Leary of MuniLand Asset Management, thanks for assessing and doing some research on the President's State of the Union address. Thanks. Time now for our Deal of the Week with Thomson Reuters MMD's Dan Berger. Dan, tell us about your deal this week.
The deal of the week is Los Angeles Department of Water and Power Revenue Bonds. It's a AA rated credit that's going to be priced on Thursday.
What are some of the strengths in this particular issuance?
Its strengths include that it's a very well-managed system. It has low-cost power that it's able to pass on to its customers. A final strength is that it has debt service coverage of over 3 times for 4 out of the past 5 years.
How about risks?
Its risks include the fact that it has a very large capital finance program, which might include some capital improvement program, which might include some additional bonds. And California has a very rigorous environmental protection, which may be challenging for them to meet.
You said it was going on sale on Thursday. How's the deal itself structured?
We believe that it's tentatively priced for Thursday, and that there'll be a retail order period on Wednesday, and they'll give preference to retail investors.
And is that where most of the demand will come from, do you think, retail investors?
Retail investors or their proxies, mutual funds and California mutual funds, yes.
All right, Dan, thanks so much.
Thank you.
If you look at water infrastructure businesses, there's an inherent link to the construction cycle. So we've seen some very strong performance in 2012 relating to the recovery in the US housing market, particularly the refurb side of that market. We would expect commercial and industrial to recover somewhat towards the back end of this year with a sort of 6 to 9 month lag. But that industrial exposure is very much the driver behind share price performance of those businesses. There is also sort of an inherent link into municipal capex and utility capital expenditure. We've seen, obviously, the recovery in the housing market drive healthier or marginally healthier municipal budgets, and a lot of projects which had previously been on hold are being released, and we're starting to see some very, very early signs of a pickup in that market.
Now let's look at the week ahead with MMD's Dan Berger. Dan, when you look out to next week and beyond, where are investors supposed to maximize returns?
Well, we're not very big on the muni market right now as it is, because we don't think that investors are getting such great return when you look at the ratios of munis to treasuries. But that being said, we like the 10-year range as the best sweet spot of the curve. After that, you do get increasing rates of return, but it diminishes.
And are high-quality bonds still the place to be?
Yes, high-quality bonds are the place to be, because we looked at quality spreads, and quality spreads are at their yearly low, which means that if spreads revert back to the mean, you'll underperform with low-quality bonds. So high-quality bonds are the place to be.
And in terms of fund flows, what are you seeing at the moment?
We were very encouraged about fund flows. For the first time, fund flows have picked up in the past 3 weeks. Last week it was 100 million, and this week it was 500 million, which was very encouraging for retail investors. Shows that there's been an increase in demand.
And what about the calendar next week?
The calendar next week is going to be increased. It's going to go, this week it was 4.4 billion. Next week is going to be 5.5 billion.
All right, MMD's Dan Berger, thanks so much.
Thank you.
I'm Rhonda Schaffler. This is Reuters.